Welcome back to another interview. Today we have the pleasure of welcoming back Ryan King, who's the Senior Vice President of Calibre Mining. Hi, Ryan. How are you?
Hey, Justin, I'm very good. Thanks for having us back on.
Yeah, thank you for being here. And I'm honestly really happy to have you because first of all, you've got some good news. But then second of all, these are just really trends that everyone's paying attention to right now. So I saw some recent news from Calibre Mining. Could you please tell me what that was? And then any context that might help investors.
Oh, absolutely. No, it is a very interesting time in the macroeconomic landscape, as you and I talked about before recording. But I guess to your point, Calibre had some very positive news today. We've acquired a major deposit and asset in Canada, and we've been advancing that through construction. We're well over 90% now. We're heading towards Q2 first gold. And during this process, what we do is we do what's called infill or ore control drilling.
Mm.
These are big open pits that we're talking about. And this ore control drilling is drilled tighter space drilling. So it's closer than what you would do when you're trying to discover or delineate a deposit.
Mm-hmm.
And in this ore control drilling, we build a model to see how it compares against the technical report or the reserves that were built. And what this tells us is that in today's news, in one of the pits, it told us that there was about 30% more tons, and which results in obviously results in a positive impact, 30% more gold in that volume of rock that compares to the 2022 reserve. So we're finding more gold. So what that means is less waste in the pit, more gold in the pit, which would inevitably result in lower cost to produce more ounces. So this is very, very positive for the company as we get closer and closer to producing that gold, because we'll be likely doing that at a higher grade and we'll be able to do it for a longer period of time. But what's important about this is not just today's news, because when we look back in 2024, we actually put some ore control drilling results out from another one of the pits. So there's three major pits that are going to be feeding this plant. And that's as it stands today. But the other pit was called the Marathon open pit. And in the initial benches at the Marathon open pit, in that ore control drilling, we saw a 47% increase in grade for a 45% increase in overall ounces in that same volume of information as compared to the 2022 mineral reserve. So really exciting stuff here for the company as we develop this new major gold mine in Atlantic Canada to transform the business.
So Ryan, I can hear you losing your voice a bit. And again, we joked off camera, but that's because you're just talking to so many people because the news is so exciting. And part of why I enjoyed having you back was that I joke about this frequently, but there's not that many Canadian success stories where there's a lot of Canadian companies. There's a lot of them. I talk to a lot of them. Not a lot succeed. And part of what I'm curious on here as a follow-up is you guys have a bit of a different approach to the way that you look at new assets because these assets are not new. You've done this more than once. You've done it around the world. You guys have been able to take an asset that is maybe undervalued, underappreciated, and then again, go and extract more value for shareholders. That's why I think the stock is being rewarded, is because there's the expectation versus the delivering. And I remember when we did our first interview, I think this is like 2 years ago now, when you said that people still don't trust our template, our process, and you guys have the track record of success. You got the people, process, and the product. That's why I like what you have. And this continues to get further de-risked is the way I look at it. So can you please just remind me, like, what's that formula? And how are you guys able to find more value consistently than other miners?
I'll be honest with you, Justin. I mean, I think that, in some cases, a bit of it is luck, but a lot of cases it's people, the right people doing the right role, being in the right role, looking at things objectively, and really not being too hubris about how they do their role and how we do our analysis of things. There's a lot of folks out there that can be a little bit too hubris when it comes to different assets. Sometimes you got to step back and step out and look at it objectively. It's like when we acquired the assets in Central America, Darren Hall has an incredibly experienced track record of under-promising, over-delivering, but also looking at assets. You always have to look at it from different perspectives. Look at it from a different angle. What could this be? And ask intelligent questions to get to the root of what could be, a nugget of opportunity. And so, and that was the case with the assets in Central America, is that they had always been two separate entities. Well, he said, well, what if we utilize them together as one almost, even though they're separated by good Pan-American highways about 200, 250 kilometers apart? Well, let's fully utilize one and then haul material to the second. Because you recall, that second mill was actually heading towards closure. So it's really starts with the leadership. I mean, Darren's experience and expertise over the years, as you recall, he worked for Newmont for 30 years. And his role at Newmont evolved over the years, but it was looking at things, analyzing things, looking at ways to optimize new assets in their portfolio. He moved around all over the planet. Indonesia, Nevada, Peru. He has worked in so many different jurisdictions. So he brings that level of knowledge that everything is slightly different. And we always have to, check our ego at the door and look at things from a different perspective. I think that's really, really important. Leadership is such a crucial impact to how an organization operates. So that's critical.
Yeah, sorry to cut you off. I'm really happy to hear that. And part of what I wanted to say was what I said in the last interview too, was that we want to let our money work for us. So that sounds easy to say, but it's really hard to do, because a lot of times companies don't deliver on what they say they're going to do. So my follow-up question here is, I also read another news release that other companies are saying that we're in discussions, blah, blah, blah. Again, I understand that's now been we've been told the discussions are dead, but they want to mention you in a news release, which means that they're trying to get some of that juice. So what that tells me is that other people are now recognizing the template. But here's the question, Ryan. So if today you guys were looking around the world with a new geopolitical landscape, there's a whole world around there. We have a CEO who's experienced. Where do you guys think the opportunities are right now? Is that to make do with what we have? Again, improve what we have, make sure we do that? Or are there other areas or other potential projects you're looking at that might be opportunistic?
Yeah, it's a good question, because you always have to be looking. We always have to be analyzing, because our job as executives of the company is always to try and extract value with either what we have or what we could do from a business combination or an acquisition or something perspective to create share price performance. That's our job. We work for the shareholders. But right now, today, honestly, Justin, I think we would do our shareholders a disservice if all of a sudden there was a new shiny bauble over here that we took on.
Okay.
And distracted us from what is so critically important to get additional value for our shareholders in this new mine. Right? We have limited human capital here. We always try to run a lean organization, but effective and also efficient. So right now our focus is Canada. And if you look at some of the other larger kind of companies that have had a good track record in business, what has been effective is going from a lower tier, quote unquote, jurisdiction that maybe you're not getting full value because investors are a bit concerned about a jurisdiction, to a tier one jurisdiction that has that we believe is on the cusp of maybe a tier one asset in a tier one jurisdiction. I think we're very early days this asset that we're developing. And what I mean by that is, as a gold producer, as a mining company, what you look for is that diversified portfolio. But inside those assets, it's organic growth that can drive share price performance. And some really interesting information about this Valentine asset in Newfoundland is that it's been only explored for about 15 years, and 5 million ounces has been discovered. Yet the geology, the faulting system on this property is analogous to different jurisdictions, like in Ontario, in the Abitibi, where there's big fault systems like we have in Newfoundland at the Valentine project, but have been explored for 100 years and produced well over 100 to 150 million ounces of gold. Right? So that's the opportunity for us right now, is to unlock that type of value, because we've already made discoveries on this property and we're advancing towards producing our first gold right around the corner here. So I think, to answer your question succinctly, it's got to be focused on delivering what we have to drive value for our shareholders, but then look beyond that potentially.
I'm so happy to hear that, Ryan, too, because when your plate is full, you might still be hungry, but sometimes you have to just deal with what's on the plate right now. And I'll repeat back what I heard, because there's something there that I picked up on that's really important to me, is that right now, so everyone says we want to be in a tier one jurisdiction, blah, 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 because there's geopolitical risk. Well, right now that seems like a pretty smart thing. But tier one can mean it's not just Canada. There's more than one place. But if I was to guess, acquiring the asset you have today with the numbers you had a couple of years ago, it would not be the same price, because now strategically that is worth a lot more, not just to the country, but also to the continent and to a lot of other people who are, again, motivated to see that asset move forward. So if this is truly a tier one in Canada and you're a Canadian company, I think this might be the place to focus your energy. That's the takeaway that I got. That's a great answer. I really like that.
Well, and it was well put, because I mean, as we look through all of this, so many different peers in our group, in our kind of mid-tier gold producer or senior gold producer, are having challenges in various different jurisdictions. And the number one place they're looking for assets is Australia, United States, and Canada. So fortunate for us that we put ourselves in a balance sheet financial position to quickly act on the opportunity that was Marathon Gold that we closed on in January of 2024. 5 million ounces of gold in Canada, 50% through a build, and we picked that up for $250 million US. So we were nimble enough, and we put ourselves, our business, we ensured we didn't, lever it up with debt or other things, but we put ourselves in a position such that we could be nimble enough. And I think something similar will happen post Valentine build, construction, ramp up, delivery. I mean, you think about it, next year, 2026, we'll be in that 400 to 500,000 ounce a year gold producer status profile. And we will focus on the organic growth that we have in the business at the time, but we will also pay down debt, put ourselves in a position such that we could take advantage of another opportunity that may present itself in the future. And that's really what it's about, making sure you don't over-lever yourself, making sure you're flexible enough to make a quick decision on attractive assets.
Financial freedom, whether it's personal or business, is freeing, because you're able to say no to things you don't want to do. And when there's good opportunities that come up, you're like, yes. And you don't have to hesitate. It's opportunistic and it just makes sense. That's what I really like. I got two more quick questions for you, Ryan, if you don't mind. So the first one here is we're noticing that there's a lot of demand around the world. So I guess what I'm wondering is, like, now that gold is like at new all-time highs, where do you think we are in the cycle? Like, what I know, again, I'm not a gold expert. I'm a gold connoisseur. I'm not an executive. Here's what I know. I know that generally there's a cycle. In our last interview, we talked about a super cycle, which means it'll last a super long time. We're now at new all-time highs. Gold in US dollars was the last currency to join. It's now there. It's now in new all-time high territory. So what I understand is that gold moves first. We're seeing that happen. Majors move second, and then mids move third, and then the juniors move last. But what I also understand is that there's usually a multiplying effect, or beta, which means that if gold moves X, then majors will move Y, they'll move more as an amplifier, and then further down the risk spectrum, it'll go higher and higher. So a little bit loaded question, but like, where do you think we are, like, currently in that cycle we talked about? And then what are you noticing out there for, like you said, like your peers, maybe the majors and the juniors below, like in terms of value?
Yeah, lots of things in there that you got to really think about from almost a crystal ball perspective.
Sorry.
But I mean, obviously good questions, because where are we at in the cycle? Especially when you're seeing all-time high gold prices. Did I miss it? Right? Have I missed out on some of the upside potential with gold prices? But you think back to the early 2000s, for example. The early 2000s is an interesting time when gold was at like $250, $300 an ounce. And you look over the years as the macroeconomic landscape changed and more kind of quantitative easing impacts started to come into the overall global landscape. And you saw gold just slowly creeping up. And then finally, during the financial crisis, there was a dip in everything. And what drove recovery was precious metal prices went up tremendously. Like from 2008 I think probably hitting a low of around $750 or $800 an ounce to driving up 2 or 3 years later to $1,900 an ounce. And and now you put it into context, what we've gone through over the last 5 years, much more quantitative easing, right? Huge amounts of global debt, particularly as we've seen in the United States, Canada, and other countries. Gold prices have risen, yes, but really they haven't caught up to that level of magnitude of quantitative easing, in my view, right? In my view, there's very few asset classes other than what we've seen in like the Magnificent Seven and others that have really gone crazy because of the flood of capital that has gone out to stimulate the world. And so if you look at gold as an asset class, there's a tremendous opportunity still here riding that quantitative easing. Then you layer on things like de-dollarization. It's a significant impact that is slowly but surely creeping out there. And I think you and I talked about this a little bit briefly. You mentioned how Indonesia is now trading in different currencies with other partners, as is Saudi Arabia with China. I mean, it is evolving. I wouldn't say at a rapid pace, but it is evolving such that people are pulling away from that US dollar kind of reserve currency as a mechanism for and a medium of exchange. And are we heading towards more of a store of value to back currencies more than like a GDP or something? Could be, right? Could be. We're hearing a lot of noise out of the BRIC nations, for example, right? And you see those BRIC nations, what are they buying? The central banks around the world, particularly those BRIC nations, are buying extreme amounts of gold, physical gold. We heard that China's been buying for many years. They paused for a little bit in 2024. Then they started buying heavily again in Q4 of 2024. They're selling treasuries and buying gold. And so, we're seeing this commonality happen. Gold is now starting to rise, but to your point, gold equities have not risen like they have in the past. And sure, there's competing products, cryptocurrencies, right? It's a competing product. It's a multi-trillion-dollar sector. So it's a competing to it's a Bitcoin, a digital gold, all of these types of things. But the tried, tested, and true through thousands of years has been gold, physical gold. And pre-cryptocurrency, you saw that gold equities would generally trade higher beta to the gold price. You get that additional leverage. But what we've seen over the last 4 years, has been a major disconnect between the gold price and gold equities. I don't even think we've seen, like historically, I think it's been a little higher than 1 to 1. Now we're like, 0.3 or 0.4 to 1 on a valuation basis. So there's a catch-up trade that I believe very likely will happen. And part of the reason is that companies have cleaned up balance sheets, have reduced debts. Companies, i.e., junior gold producers, mid-tier gold producers, senior gold producers, they have cleaned up in terms of costs, efficiencies, that balance sheet perspective. So they're paying dividends. They're buying shares back. They're being smart about M&A acquisitions rather than just doing something and then writing a whole bunch of assets off. So there's some real clever thought that's gone into the last 10 years in the gold mining business. And I don't think folks are really catching on to that. Like I had a well-known investor and kind of talking head in the space. His name is Adrian Day. He runs some pretty significant money in the US looking at this sector. And he had done, I guess he had heard there was an analysis done by Bank of America. And it basically was a survey wondering what percentage of gold or gold equities portfolio managers, the average portfolio manager or investment advisor had in their portfolio. And I think across 200 or 300 candidates that were in that survey, less than 1% ownership in any gold or gold equity. So where are we in the cycle? I mean, it's going to bump along the way. We're going to have ups and downs, but I believe that we're probably, I'm going to call it kind of inning 4 or inning maybe 5 even. So we are getting there. We are seeing the catch up last year gold was up, I think it was over 27% last year.
Mm.
January's gold price is up pretty significantly. The gold equities are up year to date. But you know, you look at the majors and there hasn't been a lot of share price appreciation in those majors.
Mm-hmm.
But there has been good appreciation in the mid cap or intermediates that maybe have more control or more managed portfolios that potentially aren't as huge of assets, but can be managed and control cost profiles.
Mm.
So, you know, I do think you're going to continue to see gold price escalation. And I think you're probably going to see equities start trading closer to that ratio in how gold is trading.
Okay, so there's a lot in there, and I really appreciate the detailed answer because I didn't realize it, but when I jammed that question, there was a lot in there. So thank you for that. So I'll just repeat back a few more things, and then if you have any final comments, we'll talk about the company, then we can leave things there. So at the beginning of this year, the BRICS are now 40% of the world. They've added on new additions. So they've talked about creating a new currency where they understand there's macro trends happening between the West and the East. The East understands hard dollars, right? Something you can hold in your hand, like a gold bar. It's why during Chinese New Year, or like India is the biggest purchaser. I think it's around this time where they buy all the gold. They like gold. They love it. What does the West like? They like digital gold. They like fake gold. So they like things that they can look at on the screen. Where in the East, they like things they can hold. We're also really noticing a big shift between who the US is going to trade with. There's a lot of trade dynamics right now. So trade and currencies matters, but you can't. Part of what I've also noticed is the US weaponizing the US dollar, where companies want to get away from it because they're like, well, if tomorrow you're going to take away our assets, that's like really bad. So we need to diversify some, even if it's 1%, 5%. And then the last thing I heard was that this tailwind for gold is starting. And when I think about it, over the last, like, say, roughly 3 years, stocks did really well in 2 out of the 3 years, but gold has actually done well in all the 3 years, which means that this QE is not really seen its way through. And a really good metric I like to look at is the US M2 money supply divided by the S&P 500, which means that in nominal terms, the S&P is at new all-time highs, but in purchasing power, it's not because they've printed too many dollars. And that's the macro trend that I see. But last point, and then curious on what you have to say here, is a lot of times it takes longer than you think possible for things to happen, and then it happens like all at once. So these undertows eventually get into a really big wave, and then it's a crash where everything happens all at once, and people wake up and say, "Wow, what happened?"
Right.
And then I cut my teeth in the late 2000s trading gold. That's how I got started in stocks, and I got my butt handed to me more than once because I didn't know what I was doing, but I realized what the cycle was, and that's what really interested in me in the market. So really enjoy the conversation, Ryan, and curious if have any final thoughts there.
No, I think we've covered a lot of perspectives around global macroeconomics, things that are happening right now. You're seeing, as you just said, what is important is that I think you said it, but I think it's really important driving this home is the weaponization of the US currency. That what happened there not too long ago dramatically changed, I think, the way a lot of countries look at, you know, their hard asset store of value behind in their central banks. And I think that's why we're seeing a major shift, maybe not a major shift, it's slowly happening, but you're seeing a shift of owning more physical assets like gold versus, you know, a US currency. So that's been a big part of the shift of central banks buying a lot of gold. And I think that's growing. We'll see what happens. Gold is a cyclical commodity. Everybody's quite aware of that. But there's this underlying current de-dollarization, weaponization of currencies, tariffs, a lot of geopolitical activities happening out there right now, debt levels like we've never seen before. So it feels prudent to me to at least have some physical, maybe looking at having a portion of a portfolio in a gold or a gold equity, particularly one that I think you said that you got your ass handed to you because you didn't know what you're doing. And so it pays to research, to understand, to evaluate, talk to the company. You know, maybe it's even try to get some analyst reports from third-party perspectives, those types of things. So so that people don't lose their ass And I think that's why we haven't seen generalist investors back into the gold sector, is because a lot of people just piled in and all boats rose in that environment. So I think you've got to be very, very kind of ninja-esque in your investing and picking the right horses to ride, right?
I fully agree. And I'll repeat that one more thing because this is what the investors really care about. So the takeaway that I heard you say is that central banks own a basket of currencies as their foreign reserves. Gold will be one of those reserves. Now they're deciding that it's worth us to increase that level, that percent. It's not like it's going to go to 100%, but it's going to go from where it is now to a higher number. What factor? We don't know. But the same thing for investors, where if you wake up one day and you realize that, oh, this is not, if you're invested in all the same things, you're not really diversified. You're just buying different stuff. You're not really going to get the benefit of diversification. That's what gold is. It's supposed to be a benefit.
Yeah.
So whatever that portion is, that's right. That's right for you. Just find that number. And then finally, Ryan, you mentioned that you have a keynote address you're going to be giving a bit later in this week. So maybe I can leave a link in the description if that's helpful. And maybe you could just tell us what you're going to be talking about.
Oh, sure. Fortunately, we'll be talking about a little bit of the same thing, but I have the opportunity to go and present at Michael Campbell's Money Talk World Economic Financial Outlook Conference here in Vancouver.
Mm.
And of course, we'll be talking a little bit about gold, and maybe why gold equities. You know, there's a disconnect there and potentially an opportunity to realize some value in looking at some of the quality gold equity names.
Mm.
And of course, I'll be talking about Calibre because Calibre, I believe, fits into that category. It's interesting because Calibre is a story that is evolving this year. It's a big year for Calibre. We're evolving from a junior gold producer, which is a category sub 500, sub 350,000 ounces of gold a year, to a mid-tier gold producer as we bring on this new asset in Canada. That again is Atlantic Canada's largest open pit gold mine. So it's a transformational year for our business. And I think dovetailing that with, we've got to talk a little bit about the underlying commodity because that will dictate, a lot of how equities will perform in the future. No matter how you operate your business, the underlying commodity, we are price takers, but we have control over certain things within our business and certain directions that businesses take. So we've got to be prudent, flexible, but also recognizing that we are at the whim of gold prices. So let's operate our business at lower than expected revenue prices. Try to underpromise and overdeliver. I think our industry has a reputation of overpromising and underdelivering, which disappoints on the share price performance. So let's get back to doing something that will have a positive impact on the sector. And I think we'll attract back some of these generalist investors that have been disappointed in the past.
Well, thank you for your time, Ryan, and for the audience. So what Ryan mentioned is if you want to learn more about the company, again, I'll leave some links in the description for you to look at. And Trump is going to be in power for 4 years. So we're just early into this potential trend. So maybe understanding what that trend could look like. And again, if it meets your investment criteria, maybe you want to look at Calibre Mining. Finally, please just make sure to read the description for full disclosure details. Thank you very much for your time today, Ryan.
Thanks very much, Justin. Look forward to the next conversation.
Thank you.